This is the Southside School of Financial Freedom Watchlist and Market Report for the week ending September 3rd, 2022. Our question this week is, what are the stages of a bear market? The answer will be provided later in the video. This week, the market ended lower. The Dow Jones Industrial Average decreased minus 1.07% on Friday and was down minus 2.99% for the week. The S&P 500 decreased minus 1.07% on Friday and was down minus 3.29% for the week. The Nasdaq decreased minus 1.31% on Friday and was down minus 4.21% for the week. Looking at the week, we can see that there were 13 down finishes versus 2 up finishes for the major indexes. On Monday, Tuesday, Wednesday, and Friday, all the major indexes finished down. On Thursday, the Dow Jones Industrial Average and the S&P 500 finished up, but the Nasdaq finished down. The new unemployment claims were 232,000 versus 245,000 expected. Job openings in July topped 11.24 million versus 10.2 million expected. Private payrolls increased by 132,000. Non-farm payrolls rose by 315,000 in August versus 318,000 estimate. Mortgage demand dropped 2% for the week. The dollar index hit a 20-year high on Thursday, and the 2-year U.S. Treasury yield hit a nearly 15-year high. New unemployment claims, job openings exceeding expectations, private payrolls falling short, non-farm payrolls falling just short, mortgage demand dropping 2%, the dollar index hitting a 20-year high, and the 2-year U.S. Treasury yield hitting a nearly 15-year high are all news. And news drives the market, good and bad. Day-to-day predictions on whether the market is going to go up or down are virtually impossible because predicting the news is impossible. However, the market is ready to go up. It does not go up every day or even every week, but the market will generally go up over time. Stock prices move in a random fashion. They go up and down with an upward drift. The market will go up for as long as the powers that be want the market to go up. While there are many powers out there, the top 5 powers that be are the Federal Reserve, big financial institutions, big corporations, the President, and Congress. These 5 entities will do what they must to drive the market higher. Now we are at our question of the week. What are the stages of a bear market? A bear market occurs when the market declines by minus 20% or more from a recent all-time high, and the decline lasts for at least 60 days. Bear markets generally last for just over a year. A bear market has 3 distinct stages. Stage 1 is the sell-off. The sell-off tends to take place gradually after the market has hit an all-time high. The buy the dip or even dollar cost averaging strategies may stop working depending on how long and deep the bear market lasts. Stage 2 is the reversion bounce. The reversion bounce is often called the dead cat bounce. In this stage, the market rebounds and goes higher. The market may stabilize and hold firm and go even higher. At this stage, the buy the dip strategy will seem to be to pay off. But just like a dead cat bouncing, the market may bounce several times, that is, go up, but each time the bounce gets smaller and smaller. Then we hit stage 3, which is the capitulation and the final drop stage. At this final stage, the market struggles to hold on to its recent gains, gradually sinking lower day by day and then suddenly dropping hard as many investors and traders give up. That is, they put up the white flag, they capitulate to the market's gradual declines. And they too sell their holdings, causing the market to drop further and faster. What stage do you think the market is in right now? What stage are your stocks in? Or do you own any stocks at all? If not, why not? Is it because you do not understand anything about the stock market? Well, it was not taught to you in school. If you ever want to learn how to get wealth and income through the stock market, you are going to have to teach yourself. You must RSI, that is, read, save, and invest. Formal school taught you how to read, but society and the powers that be discourages you from reading, especially books. School taught you to be a worker. They did not teach you how to be an investor, and they taught you absolutely nothing about the U.S. financial system. You can learn how to be an investor if you simply start reading books about investing, books that you can borrow from the library for free or buy cheaply online. It is not difficult to learn how to be a passive investor, which is what most people should do. Check out this list of recommended books on the books page of the Southside website. These books and others like them will not tell you which direction the market is going to go, but you can learn how to make money in the market no matter what the market does. I don't know which way the market is going to go on a daily basis, and I don't care. I trade the market as it is, not as it should be. I take what the market gives me, whether it's going up, down, or even sideways. How do I do that? I apply the Southside strategy. You can learn more about the Southside trading strategy at southsideschooloffinancialfreedom.com. Here is the Southside trading watch list from the week ending September 3rd, 2022. The strongest performer on the list this week is Editas Medicine Incorporated, ticker symbol EDIT. It's in the third column. It decreased minus 3.83% on Friday, but did not change for the week. Editas is a clinical stage genome editing company that focuses on developing transformative genomic medicines to treat a range of serious diseases at the genetic level. Looking at a summary of results, you can see that Editas has decreased minus 44.14% year to date. I did not trade or generate cash flow from Editas this week, but I have in the past. Whether a stock goes up or down, you can generate cash flow from it. Whether you own a stock or not, you can still generate cash flow from it using the Southside strategy. The Southside trading strategy involves trading for weekly cash flow, that is, trading for income. SPY is shown at the bottom of the third column. SPY is the S&P 500 ETF. This is the benchmark I compare my trading performance to. My objective is to beat the S&P 500 index while at the same time generating cash flow. Most professional money managers do not consistently outperform the S&P 500 index. They usually lose and lose badly to the index. Thus, most investors and traders should just invest in or trade a market index fund or ETF like SPY. What do you do? Do you beat the S&P 500 index? Do you have a watch list? What is your investing and or trading strategy? How well do you do against the S&P 500 index ETF SPY? Let me know in the comments section. Are you willing to share your strategy? The Southside Portfolio Cash Flow System is outperforming the S&P 500 index ETF SPY. The Southside Portfolio is down minus 2.62% versus minus 17.42% down for SPY, a difference of 14.8%. The Southside is beating SPY by almost 15%. The cash flow generated by the Southside cash flow system for this week was 7.61% of the portfolio account value. The account value changed by minus 7.07%. Meanwhile, the S&P 500 ETF SPY changed by minus 3.22%. Bitcoin watch. Bitcoin lost 3.36% this past week, and it continues to be in a bear market. It is down just over 71% from its all-time high, which was achieved in November 2021. I sold option contracts on two positions this week, one call and one put, that ranged from $76.69 to $189.38. You can get more details, including the total dollar amount of cash flow for the week, on the website southsideschooloffinancialfreedom.com. To increase your financial understanding of the stock market, please check out past videos for other questions of the week. The videos are organized in playlists levels 1, 2, and 3. Level 1 being for beginners, level 2 is for intermediate, and level 3 is for more advanced investors and traders. The videos are also arranged in playlists by subject matter. In the meanwhile, please like, share, and subscribe.